Hi, this video will discuss the impacts of a tax, summarizing the impact on the price the buyer pays, the price the seller receives, and the tax revenue generated by the government. Please see the Philadelphia soda tax examples when the tax is imposed on the buyer, then the tax is imposed on the seller, and tax incidents for further discussion of the mechanics behind shifting demand and supply curves. But this video is a summary of those tax impacts. So without a tax, the price is PE and quantity is QE. And when we implement a tax of size T, this causes the price that the buyer pays to increase to PB. It causes the price the seller receives to drop to PS. And this causes a reduction in quantity to QT. T represents the size of the tax. So the government generates a tax revenue indicated here by T times QT, or this area that's shaded in pink is the tax revenue area. This small white triangle there's a term for this, it's called deadweight loss. So we're using now a tax wedge instead of shifting demand and supply curves. Because the results are the same, whether you place a tax on the buyer, there's a video for this. Whether you place a tax on the seller, there's a separate video for this. You will see that you get the same results, so therefore we'll use something called a tax wedge, which is the vertical distance between the demand and supply curves, which represents the per unit amount of the tax. You don't need to worry about which party, buyer or seller, is taxed, since in the end, you get the same result. So let's revisit this curve and now call this amount of tax T our tax wedge. This tax wedge is this red distance between their demand and supply curves. You don't need to shift demand or supply. Just let the tax wedge be the amount of the tax per unit. Where the tax wedge hits the demand curve will tell you the price the buyer pays. Where that tax wedge hits the supply curve will tell you the amount that the seller receives after the tax. Once again, you get the same tax revenue area using the tax wedge instead of shifting demand curves when you tax the buyer or shifting a supply curve when you tax the seller. I find tax wedge will make your life much easier. Encourage you to use the tax wedge. Don't be fooled about which party is taxed. Just use the tax wedge for that amount, and you can find the price the buyer pays, the price the seller receives, where that tax wedge hits the demand and supply curves, the new equilibrium quantity, which of course is smaller.